What if your crypto made you money while you slept, without trading, without speculation, without doing anything? I asked AI to design a passive crypto income system for a regular person with $2,000. Here's the blueprint it gave me, and the results 3 months in. Passive income from crypto is real, it's also misunderstood. There are legitimate ways and there are scams that promise 50% returns and disappear with your money. Today we're covering only the legitimate ones, the ones AI recommends based on risk-adjusted returns. Our first strategy, and arguably the most foundational way to earn passive income in crypto, is staking. If you've heard the term but aren't quite sure what it means, you're in the right place. At its core, staking is a way to put your crypto to work, directly supporting the security and operations of a blockchain network. To understand staking, we first need to touch on something called a consensus mechanism. It's how a blockchain validates transactions. You've likely heard of Bitcoin's proof of work. Uses immense computing power to solve complex puzzles. Proof of stake, used by networks like Ethereum, is a more energy-efficient alternative. Instead of miners competing with hardware, users called validators lock up or stake their own coins as collateral to get a chance to validate transactions and add new blocks to the chain. When you stake your coins, you're essentially lending your economic weight to a validator, vouching for their good behavior. In return for this crucial service, for helping secure the network, the protocol rewards you with more coins. This reward is your yield. Think of it like earning interest in a savings account, but instead of lending your money to a bank, you're lending your crypto's security value to the network itself. Now, you don't need to be a tech wizard to do this. There are several ways to participate. The most straightforward method is staking through a centralized exchange like Coinbase or Kraken. It's often as simple as toggling a switch. The exchange handles all the technical complexity for you, making it incredibly beginner-friendly. The trade-off is that they take a cut of your rewards, and you're trusting them with custody of your assets. A more decentralized approach is liquid staking through platforms like Lido or Rocket Pool. Here you deposit your coins into a smart contract and receive a liquid staking token, or LST, in return. For example, if you stake Ethereum, you might get STETH. This LST represents your staked coins and the rewards they accrue, but it remains liquid, meaning you can trade it or use it in other DeFi applications, all while still earning staking rewards. This offers more flexibility and self-custody, but it does introduce smart contract risk. So, let's talk numbers. What can you realistically expect to earn? The yield varies by network and market conditions, but for Ethereum, the current annual reward rate typically hovers between 3.5% and 4.5%. Let's be conservative and use 4% for our example. If you stake $2,000 worth of Ethereum, a 4% annual percentage yield, or APY, translates to $80 per year. That breaks down to about $6.67 per month. Let's scale that up. With a $5,000 stake, that same 4% APY would generate $200 per year, or about $16.67 per month. And with a $10,000 stake, you'd be looking at $400 per year, which is roughly $33.33 per month. It's important to remember these figures are before any fees from exchanges or platforms, which can range from 10% to 25% of your rewards. And of course, this is not financial advice. Yields are dynamic and can change. No, this isn't life-changing money on its own, and it's certainly not our target of $100 per month just yet. But this is the critical first layer of our strategy. Staking is the bedrock. It's relatively low risk compared to other crypto activities, it's consistent, and it allows our base assets to grow steadily. We're building a foundation, and from here, we'll add more layers to build our income stack. Now, let's explore our next strategy for generating passive income: crypto lending. Think of it like a high-yield savings account, but for your digital assets. Platforms in this space allow you to lend out your cryptocurrency, such as Bitcoin or stablecoins, to others and earn interest in return. This is a foundational strategy in decentralized finance, or DeFi, and it comes in two main flavors: centralized and decentralized. First, let's talk about centralized lending platforms. These are companies that act as trusted intermediaries. Much like a traditional bank, you deposit your crypto with them, and they manage the process of lending it out to borrowers, who are typically institutions or traders. In exchange for custody of your assets, these platforms offer a straightforward user experience, customer support, and often, insurance on your deposits. The interest rates are usually predetermined and stable. For example, lending a stable coin like USDC might currently offer an annual percentage yield, or APY, between 8 and 12%. On a $1,000 deposit, that translates to earning between $80 and $120 per year, paid out in the same currency you deposited. The primary risk here is platform risk. You are trusting the company to secure your funds and manage its own finances responsibly. The second flavor is decentralized or on-chain lending. This happens on protocols like Aave or Compound, which are built on blockchains like Ethereum. Here there's no central company. Instead, you interact directly with a smart contract, a piece of code that automatically executes the terms of the loan. You supply your assets to a liquidity pool, and borrowers can take loans from that pool, provided they post sufficient collateral. The beauty of this system is its transparency and self-custody. Your funds are controlled by code, not a corporation, and you can withdraw them at any time as long as the pool has enough liquidity. However, the interest rates, or APYs, are variable. They fluctuate in real time, based on the supply of assets from lenders and the demand from borrowers. This means your earnings can change day by day. The risks are also different. You need to be mindful of smart contract risk, which is the potential for bugs or vulnerabilities in the code. Now, let's move on to our third strategy, yield farming. This is a more advanced technique, but recent tools have made it much more accessible. At its core, yield farming means providing liquidity to a decentralized exchange, or DEX. These exchanges don't use traditional order books like the stock market. Instead, they use automated market makers, or AMMs, which are essentially pools of two different tokens. For a decentralized exchange to function, it needs a deep supply of tokens for traders to swap between. Yield farmers are the ones who provide this supply. When you provide liquidity, you deposit an equal value of two tokens into a specific pool. For instance, an ETH and USDC pool. In return for locking up your assets, you earn a share of the trading fees generated by that pool every time someone makes a swap. This is where the yield comes from. These fees can be quite attractive, sometimes leading to APYs well above what you'd find in lending. However, yield farming introduces a unique risk called impermanent loss. This is a complex topic, but the simple explanation is this. If the price of one token in the pool changes significantly compared to the other, the value of your deposited assets can end up being less than if you had simply held them in your wallet. The trading fees you earn are meant to offset this potential loss, but it's a crucial trade-off to understand. The risk of impermanent loss is lower in pools with two stablecoins and higher in pools with more volatile assets. So how do you navigate this complexity? This is where modern tools come in. AI-powered analytics platforms can now analyze thousands of liquidity pools across different blockchains. They help you assess the risk-adjusted yields, comparing the potential fee income against the historical volatility and risk of impermanent loss. These tools simplify the decision-making process, allowing you to find opportunities that align with your personal risk tolerance. As with all crypto strategies, it's vital to start small, understand the mechanics, and never invest more than you're willing to lose. Both lending and yield farming offer powerful ways to put your crypto to work, but they require careful consideration of the distinct risks and rewards of each approach. So, after exploring the core mechanics of staking and lending, what does a practical starting strategy actually look like? We asked the AI to synthesize everything we've learned into a clear, actionable blueprint for generating passive income. The goal wasn't to find the highest possible returns, but to create a balanced, risk-aware model suitable for a beginner. This is that blueprint. It's a foundational model designed to be understood, adapted, and scaled over time. The AI's strategy is built on two pillars we've discussed: Ethereum staking and stablecoin lending. It proposes a simple 50-50 split to start. This allocation balances the relative security and lower yield of staking a major asset like Ethereum with the higher potential returns and associated platform risks of lending stablecoins. Let's begin with a modest portfolio of $2,000. The blueprint suggests allocating $1,000 to Ethereum staking, for example through a platform like Coinbase. Based on a conservative estimate of a 4% annual percentage yield, or APY, this would generate approximately $40 per year. The other $1,000 goes into stablecoin lending on a platform like Nexo. Assuming a 10% APY, this could generate around $100 per year. Together, these two streams produce a total of about $140 per year. That breaks down to just under $12 a month. Now, it's crucial to be honest here, $12 a month won't change your life. But that isn't the point. The point is to establish a system, to prove the concept with real capital, and to build a foundation from which you can grow. This is where the journey begins, not where it ends. So, how do we get from the $12 a month to a more meaningful target like $100 a month? This is where we confront the honest math of passive income. Using the same 50-50 allocation and the same conservative yield estimates, the numbers scale in a linear fashion. To reach that $100 per month goal, which is $200 per year, the math shows you'd need a total deployed capital of roughly $17,000. If we assume slightly more optimistic but still realistic yields, say 5% from staking and 12% from lending, that required capital drops to around $14,000. This is why you often see a suggested range of $10,000 to $15,000 to hit this specific target. The AI is unequivocal on this point. Generating significant passive income requires significant capital. There are no shortcuts that don't involve taking on massive, often unstated risk. The beauty of this model, however, is its scalability. You don't need $15,000 to begin. You can start with $500 or $2,000 or whatever amount you are comfortable with, and gradually add to your positions over time. By reinvesting your earnings and making regular contributions, the power of compounding begins to work in your favor, slowly accelerating your progress toward your goal. This is the patient, disciplined path. It's less exciting than chasing fleeting high-risk opportunities, but it's a far more sustainable way to build a real source of passive income. All 3 strategies with setup links are in the description. Staking on Coinbase takes literally 2 clicks. Start there, subscribe, and tell me, what passive income strategy are you most interested in?